Hello, and welcome to Portfolio Matters Weekly Markets Checklist, week 154. But before I get into it, I will read the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we'll be discussing securities that we own or have financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Full disclaimer can be found at the end. Before we get going, some quick housekeeping items. Well, first of all, I'm back from running the Boston Marathon 3:24, if you're interested. So this week, I'm afraid you just have me, as Richard is away sailing, and I will be doing mainly the macro data over the last couple of weeks since I've been away. A full service will resume next week. Okay, news. Well, Iran attacked Israel with 330 missiles and drones, around half of which failed at launch or in flight, and the vast majority of the remainder were shot down, over half of them by the US, but also the UK and Jordan got involved. This morning, Israel appears to have launched limited retaliatory strikes aimed at Isfahan airport, if the reports are to be believed, and oil has risen. Tensions in the Middle East continue, and oil and gold have risen on the back of concerns of a wider conflict. Turning to the macro data, well, US inflation came in hot. UK inflation came in hot. Non-farm payrolls came in hot. US retail sales came in hot. All of that adds up to inflation appearing to be sticky as the US economy continues to defy higher interest rates and show no signs of slowing down. Jerome Powell has stated that inflation is not coming down as quickly as anticipated, which I think is blindingly obvious to everyone at this point. As a result, bond yields have risen as markets have pushed back on expectations of rate cuts this year. The ECB met and left interest rates unchanged. They meet again in June, where they are expected to start cutting. Commodities had a very strong couple of weeks on the back of tensions in the Middle East and market expectations of a turn in the manufacturing cycle. One chart related to the news. Well, this is the latest odds for the US 2024 presidential election. And although Donald Trump is ahead in the polls, Joe Biden is well ahead in the betting markets. Reminder, we have elections in the US in November. Okay, and on to the economic data. So, quick summary. The UK economy is weak. It appears to have bottomed, but is showing little sign of strengthening. And the latest employment data showed the jobs market continuing to weaken. In the EU, the economy is weak, but showing signs of bottoming. In the US, the economy is strong, but there are some signs that the rate of growth is slowing. China, difficult to tell. The latest GDP numbers were bang on target, but all the other data was disappointing. Global manufacturing shows signs of a cyclical upturn. Okay, turning to the UK, we had GDP numbers for February, and they were on target at 0.1%, down from January, although the January number was upgraded from 0.2% to 0.3%. Now, the IMF this week issued a downgrade to its expectations for 2024 UK GDP, forecasting that UK would grow by just 0.5%. Now, given the UK has grown by 0.4% in the first 2 months of the year, that seems pessimistic. Year on year, in February, UK GDP was minus 0.2%, which was better than expectations, but down on January, although the January number was revised upwards. We also had inflation numbers for March, and not great, missing expectations at 0.6% month on month, in line with February, but 0.1% above expectations. And year on year, that meant inflation was at 3.2%, slightly worse than consensus, but still falling. Core, that's a big miss. Core came in at 0.6% month on month in March, well above expectations of 0.3%, unchanged from February. And that meant that core only fell to 4.2% in March. From expectations, it fell to 4.1%. But inflation is still falling in the UK. Reminder, UK inflation numbers are not seasonally adjusted, and the majority of the inflation in the UK happens between the months of February and May. So high prints early in the year are not necessarily a sign of resurgent inflation. RPI came in at 4.3%, again above expectations, but still on a downwards track. The UK is in line to hit the 2% target by mid-year. PPI, good news, missed expectations. So input producer price inflation was minus 2.5% in the year to March, better than expected. Output, 0.6%. Again, better than expected, although up slightly from February. Input prices showing no signs of resurgence in inflation. The problem for the UK is services inflation, which is the dark blue line here and which is coming down very slowly. Goods inflation, on the other hand, has dropped markedly. And if we look at the contributors to the change in inflation over the past month, well, unsurprisingly, the rise in oil prices led to higher transport costs. But it also appears that a lot of mobile phone contracts renewed at a higher price. We look at the last year, well, restaurants and hotels were the largest contributor to CPI inflation. Earnings growth numbers in the UK were also disappointing, unchanged in February at 5.6%, defying expectations of a fall. Wage inflation remains too high. Excluding bonuses, it fell slightly to 6%, which was better than expected, but still way too high. Now, I've downloaded the data from the ONS, and if you look at the table bottom right, it shows the annualized rates for the raw data, and the February numbers were not very encouraging. There was a big rise in wages in February at an annualized rate of 9.3%, including bonuses, and 10% excluding bonuses. The 3-month figure is more encouraging. The good news is both private and public sector wage growth is declining. But in contrast to that, the employment data for February was all quite weak. So we had employment change numbers, which were very disappointing, showing a net drop in employment of 156,000, much worse than the expectations. The expectations were for a rise in employment and down on January. The claimant count rose by almost 11,000, up on January, although the January number was revised down sharply. The general picture is of a rise in the claimant count, although not big numbers. And the HMRC payroll data for March showed a sharp drop of 67,000, and the February data was also revised down sharply from 20,000 to minus 18,000. So the employment data in the UK shows a sudden drop in employment in the last few months. Now, the HMRC payroll data is volatile and may well be revised. In fact, frankly, I think it's likely to be revised. But while wage growth seems persistent, the UK jobs market appears to be continuing to slow. That meant the UK unemployment rate for February has ticked up to 4.2%. In fact, that's a rise of 0.3% because the January number was also revised upwards. So, although wage growth continues, the indications are the UK economy, although the output is rising, unemployment is also rising and the number of people employed is falling. Good news is manufacturing output appears to have bottomed, rising by 1.2% in February, much better than consensus, and up on January. And over the past year, it's up 2.7%, again, much better than expectations. Industrial output also rose 1.1% in February and was up 1.4% year on year, all better than expectations. Construction output, though, disappointed, down 2% in the year to February, well below expectations. And the commentary here I'm going to read. Construction output in the UK contracted by 2% year on year in February, reversing an upwardly revised expansion from the prior month. New work fell faster, while repair and maintenance activity grew the least in 7 months. Monthly construction output shrank by 1.9% in February after 1.1% growth in January. The decrease came from both new work and repair and maintenance, as heavy rainfall led to delays in planned work and decreased output. 8 of the 9 sectors saw a decline. So higher interest rates continue to have an impact on the UK construction sector. Whether the fall in February was primarily due to poor weather, we'll just have to wait and see. We also had this morning UK retail sales data for March, and that was disappointing, well below expectations. The March number coming in at 0, down from February. So UK consumers not showing much signs of recovery. Excluding fuel, sales actually fell by 0.3% month on month. And that meant over the past year, retail sales rose only 0.8%. Slightly better than expectations, but still not a great number. The UK goods trade balance for February came in, well, pretty much on target. We continue to run a huge goods trade deficit. The overall trade balance actually came in better than expected at only 2.3 billion, pretty much unchanged from January and better than expectations. The British Retail Consortium retail sales year on year for March were better than expected at 3.2%, notably better than the official figures. And the Royal Institute of Chartered Surveyors house price balance -4. So they're saying that of their members, a pretty much equal number are seeing rises and falls in the UK house market. The housing market appears to be stabilizing. Now, returning to the British Retail Consortium sales, this chart shows UK debit and credit card spending for the last 3 years. Now, it's quite a difficult chart to interpret, but the black line is 2024, and you can see that real spending is actually down on 2023, though nominal spending is in line. So the UK consumer does not appear to be doing terribly well. Citigroup Economic Surprise Index shows the UK doing better than expected. And Indeed have changed their website. So they now actually have better data, or they present it better. And this is UK jobs postings online on the Indeed website, and they are continuing to decline and below pre-COVID levels. So the indications are the UK jobs market is continuing to slow, and wage growth, though high, is also falling, but not fast enough for the Bank of England. UK trueflation is at 3% and not really declining very much. So, UK summary. The UK inflation is proving sticky, but disinflation does continue. Trueflation has stalled. Although trueflation is not seasonally adjusted, we know the majority of UK inflation comes between February and May. Wage data is highly contradictory. Wage inflation continues to be high, although it is falling slowly, but there was a sharp wage rise in February. Having said that, the jobs data is universally disappointing, with jobs growth, with the number of jobs falling, number of claimant counts rising, and the employment rate rising, and the number of job postings online continuing to fall. So it appears that actually the jobs market in the UK is continuing to slow. Good news is UK industrial output has bottomed and is rising. So the bottom line is the UK economy is currently stagnant. GDP is positive over the first 2 months of the year, but the jobs market appears to be slowing, which does not bode well for the economy over the rest of the year. On to the EU. So the ECB met and left interest rates unchanged at 4.5%, in line with expectations. They next meet in June, where they're expected to start cutting rates. Now, EU industrial production for March came in line with expectations at 0.8%, although the February number was terrible. Year on year, worse than expectations, with a fall of 6.4%, which is a big number. Retail sales for March, very disappointing, down minus 0.5%, below expectations, and EU retail sales are now down strongly over the past 3 months. Year on year, they were minus 0.7% in the year to March, well below expectations. Construction activity year on year was worse than expected and down on January at minus 0.4%. The EU construction sector is struggling with higher interest rates. The trade balance, however, was very good at 23.6 billion, above expectations, well up on January. The ZEW Economic Optimism Index, which is a survey of professional forecasters, continues to rise, and actually that is not a bad number. So economists in the EU are forecasting that the EU economy will recover over the next year. And the Citigroup Economic Surprise Index continues to be decently positive. Now, Indeed now post data for Germany and France, although not the whole Eurozone. So job postings in Germany continue to fall, but are still well above pre-pandemic levels. And wage growth is 4.2%, although it hasn't really fallen over the last 6 months. In France, the number of job postings has fallen over the last year and is still falling, but is massively higher than pre-pandemic. That may well be due to digital penetration in France, so more job postings going online. But the near-term trend is one of a slowing jobs market, and wage growth only 3.1%. So if the French labour market was as tight as the jobs postings would suggest. So the job postings showing there are far more job postings than pre-pandemic, then you expect wage growth to be higher, suggesting that the trend in job postings online over the last 3 years is just caused by a migration to more job postings being put online. Okay, EU summary. Well, industrial activity bounced in March but remains weak year on year. Retail sales continue to be weak and job postings continue to decline. The EU economy is stagnant with little sign of improvement. And on to the US. So 2 weeks ago now, after we recorded the last weekly US non-farm payrolls were published, and they were very strong, and they caused a big sell-off in the bond market as markets priced in expectations for fewer interest rate cuts. So the headline number for March was 303,000 jobs created against expectations of only 200,000. So headline number suggested continued strong jobs growth in the US. But when we dig through the numbers, once again, the headline number hid the fact that all the jobs created were part-time. Full-time jobs actually fell, according to the household survey. And full-time employment is therefore falling on a year-on-year basis. So the blue line here is the number of full-time jobs in the US, and the brown line is part-time. And you can see that over the last year, we've had a fall in full-time and a sharp rise in part-time. Not a sign of a red-hot employment market. And the establishment survey, which is the grey line, continues to paint a much more optimistic of the US jobs market than does the household survey, which is the brown line. But the household survey for March showed more job creation than did the establishment survey. So the two lines came closer together in March. And both permanent and temporary layoffs actually fell in March. So we are not seeing a rise in job losses, but once again, the majority of the new jobs created were in the government sector. If you look at the bottom chart, you'll see that change in public sector employment is much higher than in private sector employment, and private sector employment is, the growth in private sector employment is steadily falling. But jobs growth was broad, with all sectors pretty much showing a rise, including construction. Although there was again a rise in the people with multiple jobs, suggesting that people are having to do more than one job to make ends meet. Temporary jobs, which are meant to be a predictor of a slowdown in the economy, continue to fall, although, of course, there has been no slowdown in the US economy. And the number of people in temporary employment for economic reasons, i.e., because they're unable to find full-time work, has risen, but remains incredibly low by historic standards. So people who want a full-time job can find it. But since the pandemic, a lot of people appear to have left the workforce, although they're not being counted as unemployed, so retired or long-term sick. But this is federal tax receipts, and they confirm that earnings growth plus employment growth has led to a decent rise, a good rise in tax receipts. So confirms the US economy is doing just fine at the moment, and very little sign of an increase in layoffs. And another indicator which has historically worked really well but has now totally failed is the Conference Board Employment Trends Index. When that turns down, you normally see a fall in non-farm employment. This time it's turned down and employment has continued to rise. That's in part because of the government, but still puzzling. So all that meant that the unemployment rate in the US actually fell in March to 3.8%. Weekly earnings month on month grew by 0.3% in line with expectations, and actually that's not such a bad number. 3.6% annualized. Year on year, it's at 4.1% and falling. The participation rate ticked up, that's good news, to 62.7. Hours worked rose back towards their long-term average at 34.4, better than expected. Government payrolls were 71,000. Private payrolls 232,000, much better than expected. Although all those were part-time jobs, of course. The U6 unemployment rate, which is a broader measure of unemployment, including disaffected workers who are not looking for jobs, that was stable at 7.3%. Now on to US inflation, and for March, and CPI came in hot at 0.4%. Above expectations, and a number the markets took badly as indicating that inflation was going to take longer to come down. And that meant inflation actually ticked up year on year quite sharply in March to 3.5% from 3.2% in February, above expectations. Core came in at 0.4%, missing expectations, unchanged from February, and that meant core was unchanged in March at 3.8%, still too high, above expectations, and the Fed is likely to keep rates higher for longer. PPI, however, only rose 0.2% in March, lower than expectations. So persistent inflation is not due to input costs. Presumably, it's due to wages. Year on year, it was only 2.1%, higher than February, but below expectations. Core PPI was 0.2%, again subdued, and year on year 2.4%. And if we look at CPI x everything, so like supercore, then the 3-month annualized rate has shot back up. Not very encouraging. Reminder that US inflation numbers are seasonally adjusted, but a lot of the inflation happens early in the year, and Jerome Powell has previously stated he thinks that the adjustment is not strong enough, so leaving some residual seasonality. We just have to wait and see. But the Atlanta Fed wage growth numbers for March show that wage growth is continuing to decline. And if that's true, then it is difficult to see a sustained rise in inflation as wage growth ticks down, but inflation ticks up. So workers in the US are once more seeing falls in their real wages. Now, we had retail sales for March, and they came in very hot. And the February number was also revised higher. So there's no sign that the US consumer is pulling in their horns. Reminder, we have previously covered the San Francisco Fed's estimate of excess pandemic savings, which showed that they are close to exhaustion. And so we're expecting US consumers to start cutting expenditure. Well, there's no evidence that that's happening. And ex-gas and autos, the March number looks even stronger. So it's not due to higher oil prices. Year on year, 4%, much better than expectations, up on February. So US consumer, in contrast to the British consumer, seems to be doing just fine. Now, we now have the monthly University of Michigan consumer surveys, and they all showed slight weakness compared to both March and expectations. So this is the headline number coming in at 77.9, below expectations and down on March. Current conditions showed actually a small but significant drop to 79.3, down on March, well below expectations. Expectations for the future, again, showed a small drop. Inflation expectations are ticking back up, and that won't please the Fed. The Fed is going to have to keep rates higher for longer. 5-year expectations also showed a sharp rise. The National Federation of Independent Businesses in the US, i.e. small businesses, their optimism index is hitting new cycle lows. That is not encouraging. Now, the current state of the US economy is that the government is running an enormous fiscal deficit of 5.6%. And to offset the inflationary effect of that huge deficit, the Fed has raised rates to 5.25%. Now, the people that high interest rates affect most are consumers with short-term debt, and that's mainly the low-paid. Low-paid workers tend to have debts. High-paid workers tend to have assets. And also small businesses. Small businesses in the US rely on bank funding, whose rates are linked to interest rates. Large businesses in the US fund themselves in the bond market, and they have locked in long-term low interest rate debt. So the longer US interest rates remain high, the more it affects US small businesses, who are also responsible for a lot of hiring. And what we're seeing here is the effect of those higher rates on small businesses. Now, the current state of the US economy, with big deficits and high interest rates, is having a distributional effect on the economy. So large companies doing better than small companies, and wealthier individuals, wealthier workers, are doing better than low-paid workers with debts, and we'll cover more of that in a bit. And the RCM TICP Economic Optimism Survey, which is a survey of US consumers, ticked down in April. So although the US economy is doing well, consumers and small businesses are not feeling better. US industrial production in March came in line with expectations at plus 0.4%. That's a good number. Year on year, it's flat, below expectations, but up on February. Manufacturing production was good, up 0.5% in March, above expectations, and year on year at 0.8%, again above expectations. The Philadelphia Fed Manufacturing Index for April, so the latest data, showed a huge surge to plus 15.5, and that is strong expansion territory. So Philadelphia area, at least, is seeing strongly strengthening manufacturing sector. Building permits fell in March, but that's still a good number. Housing starts also fell in March, but that's still a decent number, although quite a sharp drop. Existing home sales also fell slightly, but in line with expectations. The Conference Board leading index, having risen unexpectedly in February, fell back in March, minus 0.3, below expectations. And the cause of that was falls in new orders and building permits. Johnson Redbook retail sales, absolutely fine, 4.9% year on year. US 30-year mortgage rates, still high. Mortgage market index going absolutely nowhere. So people not taking out new mortgages. Initial jobless claims showing little sign of doing anything at all, kind of flat. So no signs of increased layoffs. Jobs market seems to be doing just fine, as echoed by continuing jobless claims, which are not really doing anything at all. The Dallas Fed weekly GDP estimate ticked up to 1.9% over the last couple of weeks. The Atlanta Fed is at 2.9%, showing in Q1 the US economy doing absolutely fine. Citigroup Economic Supplies Index, strongly positive. Job postings on Indeed continuing to fall, which echoes the Atlanta Fed's falling wage growth numbers. And wage inflation on Indeed falling to 3.1%. Signs that the US jobs market is slowing. Trueflation, now let's hope this is echoed in CPI, but having risen strongly in March has absolutely collapsed in April to 2%. So if CPI follows that, then hopefully inflation will start to come down again. Now, the big problem for the US is that the budget deficit is 5.6% forecast in 2024, rising to 6.1% in 2025. Now, this chart from the FT shows that actually the problem is not the primary deficit, so actual spending, it's interest. And as the debt burden grows, so the interest, which is the light blue area, will continue to rise, meaning the overall deficit continues to rise. In order to get the deficit under control, the US needs to either cut the primary deficit or more than that to get interest rates down. So US summary. Well, once again, non-farm payrolls beat expectations, but once again, when you dig into the data, the actual job creation appears much weaker than the headline number. All the new jobs were part-time, and the majority of those were in government. Inflation is sticky in March, though trueflation in April shows a sharp fall. Will CPI follow? Over the past 3 months, we have seen a resurgence in US inflation. The market has now priced in US rates staying higher for much longer. We'll just have to wait and see what happens. The US University of Michigan consumer surveys show that consumer confidence in the US is no longer improving. It's fading slightly, though not significantly. Small businesses in the US are increasingly pessimistic. Bottom line, US economy remains strong. It's being supported by the enormous fiscal deficit. And to offset that, the Fed is running very high interest rates, and they are having a disproportionately large effect on small businesses and lower paid workers. On to China. The big news was that Chinese GDP growth for Q1 came in at plus 1.6%, much better than expectations and up on Q4. And so that meant that GDP growth year on year came in at 5.3%, i.e. above the Communist Party's target of 5%. But all the other data suggested actually the Chinese economy not doing as well as expectations. So the balance of trade figures for March showed a sharp drop from February and were below expectations. Export growth fell 7.5% year on year in the year to March. That was below expectations. Imports also fell minus 1.9% in the year to March, below expectations. Those are not figures you expect from a growing economy. Loan growth also disappointed. Industrial production disappointed at only plus 4.5% year on year, below expectations and sharply down on February. Fixed asset investment, though, ticked up to 4.5%. And that suggests that the Communist Party is back to its old tricks of trying to support the economy through potentially unproductive. Retail sales were also disappointing at 3.1% year on year, worse than expectations and well down on February. The unemployment rate, though, beat expectations and fell to 5.2%. House prices continuing to fall, down 2.2% in the year to March. Reminder, the FT had a story a few weeks ago where they had interviewed real estate agents in Beijing, and they believed the actual falls were between 15 and 30%. Inflation month on month was minus 1% in March. Again, not really indicative of a strong economy, which meant year on year it was only 0.1%. Inflation occurs where there's an excess of demand over supply, and so currently there's no excess demand, which again reinforces the suspicion that those GDP numbers are overly optimistic, shall we say. Producing price inflation was minus 2.8% in the year to March. And when we look at the Chinese economy and how much credit is required to produce 1 unit of GDP, well, it's been steadily increasing and is now at a ratio of 18 to 1. So you need 18 units of credit to create 1 unit of real GDP growth. And as you put in more in investment, a lot of it goes into malinvestment, leading to a big rise in potentially bad debt. So, China summary. Well, lots of contradictory data, basically. How much of this do you believe? The GDP number beat forecasts and shows that the economy is growing in line, suspiciously in line, with the 5% target. Everything else was disappointing. Onto one chart. So this is real wages in local currency terms, indexed to 2000. We've been talking in previous weeks about how the Italian economy is doing much better than the German and French economies within the Eurozone. Well, the reason is Italy has had a lost 20 years. Its workers have seen no wage growth since the start of the Eurozone. We have talked previously about how the Eurozone is not an optimal currency area, and by fixing the exchange rates between countries within the Eurozone, it means that any adjustment has to be taken by the real economy rather than by the exchange rate moving. And so you see that effect in action here, where the uncompetitive Italian economy has seen no wage growth in 20 years, whereas German and French wages have risen by best part of 20%. So over that time, Italy has become more competitive, and Italy is now doing well, doing better than Germany and France. But that's only because they've had an adjustment to their real wages over the past 20 years. I'm constantly surprised by the willingness of workers within the Eurozone to accept the real wage adjustments needed to adjust the competitiveness of the different economies. Reminder, Greece has suffered possibly one of the largest depressions in world history over the course of the last 15 years, with its GDP falling by 30%. In contrast, During the Great Financial Crisis, UK and US GDP fell by less than 5%. Now, on to US delinquency rates. And thank you to Jaw It for sending me all this. Now, one of the things I've been thinking about in the last couple of weeks is the distributional effects of the higher US interest rates, who it affects. And the people it's mainly affecting are lower paid workers in the US because they have debts. Lower paid workers, we know that very few of them have any savings at all. So any unexpected expenditure they have to try and borrow money for, and a lot of them borrow just to make ends meet. So as interest rates rise, so delinquency rates are rising, and that becomes particularly a problem when unemployment is rising. And unemployment, although it's only ticked up a bit, has ticked up, and that means people who are out of a job are falling into delinquency on all their loan types. Now, this is the Federal Housing Agency delinquency rate. The Federal Housing Agency provides mortgages to people who would not otherwise qualify. So low paid workers, essentially, and their delinquency rate actually is always astonishingly high. So 10% on average, you'd say, but it has begun to rise and has hit a new cycle high. And the percentage of its delinquencies caused by unemployment is rising very sharply and is now almost back to its post-GFC highs. And this provides wider data on US workers in financial distress. And you can see that credit card distress rates are back to pretty much their post-GFC highs, as are auto loans, although mortgages overall not that high, presumably because a lot of people locked in low interest rate 30-year mortgages. And the previous delinquency rate on housing was for the FHA mortgages, low paid workers. This is the wider delinquency rate for multifamily housing. And you see that that is also rising quite sharply, although still at a low level. But if this continues, but it's at its highest it's been since the post-GFC period. So the reason we're covering this is who is affected by higher interest rates is not the rich. They have assets, not liabilities. And so higher interest rates actually gives them higher interest payments on their assets, not large companies, because they are funded via the bond market. And during the pandemic, they locked in low interest rate long-term funding. It's small businesses who rely on bank loans and lower paid workers who have debts. And so the longer US interest rates stay high, the more it affects lower paid workers. And we're seeing this in rising delinquency rates. So the bottom line is that Biden's big fiscal deficit is having unintended distributional effects. And will that cause him difficulties in the coming election? And onto inflation watch. So the ECB met and left rates unchanged at 4.5%. We also had UK inflation data, which was disappointing, but continued to fall. So UK CPI was 3.2% in March, core was 4.2%, RPI 4.5%. US CPI numbers were also disappointing. So US CPI actually rose to 3.5% in March, and core was unchanged at 3.8%. US inflation is going the wrong way currently. So this is Goldman Sachs are bullish on US GDP, but believe that inflation will continue to fall, allowing the Fed to cut 3 times in 2024. And US net immigration, and these are the the grey bars are unauthorized migrants. US has seen enormous net immigration in the last couple of years, and that has helped ease its labor crisis, and that should be good for wage growth, and help bring inflation under control, and also be good for GDP. Used car prices continue to fall, but car insurance, we've talked about this previously in some depth, it just continues to relentlessly rise, and that is dragging headline CPI higher, and that is likely to continue for some time. Reminder, the higher car insurance rates are caused by a rise in the accident rate and a rise in the severity of those accidents, which the government is putting down to distracted driving. So people looking at their mobile phones and not looking at what's ahead of them. So they're having more crashes. And when they do crash, they're going at full speed because they haven't reacted to what's going on around them because they're on their phones. Also, electric vehicles are more expensive to repair. So when there is a crash, it's more expensive to repair. But car prices in China are falling really rapidly. And if they're allowed to export those cheap cars around the world, then car prices everywhere should also start to fall. But tensions in the Middle East have essentially closed the Red Sea and the Suez Canal to container shipping. 90% of traffic has now diverted around the Cape of Good Hope, and that means longer journey times, more expense, and because the container ships are on the water longer, that means that they're running fewer journeys between China and Europe. So it's effectively cutting the capacity of the container shipping industry. They can run fewer cargoes between China and Europe. So the question is that inflationary? And the answer is yes, it is. So the IMF have previously looked at the effect of shipping costs on global inflation, and they've found that doubling of transport costs results in a net 0.7% increase in world inflation a year later. And that inflationary surge then lasts for 18 months, producing a cumulative uplift in inflation of 1.5%. And thank you to Simon W. for sending this. This is global container shipping rates, and they've doubled, although it's fading a bit now. So if the IMF is correct, over the next year, we will see a rise in global inflation of a notable 0.7%, and that would tend to keep interest rates higher for longer. The good news is that air freight rates have continued to decline, although how much substitution there is between cargo shipping and air freight is open to question. So in summary, US inflation is currently resurgent, but wage growth continues to fall, and it's difficult to see continuing inflation, resurgent inflation in the US if wage growth continues to fall. Let's just wait and see what happens. But rising transport costs due to the conflict in the Middle East closing the Suez Canal suggest that European inflation in particular is likely to rise by up to 0.7% over the next year. Bottom line, higher for longer. Okay, onto recession watch. So in the US, we're not seeing a big rise in layoffs, but there is a small one. Permanent job losses are ticking up. Unemployment rates are rising, particularly for the better paid. Are we seeing the first effects of AI leading to some layoffs for highly paid consultants? Now, this is interesting. This is US restaurant traffic, and that's not great. So we're seeing strong retail sales, but high restaurant prices appear to be putting off customers. Now, I was in Boston last week, and I can tell you for a Brit, the US is absolutely unaffordable. So a beer in an average, not very expensive restaurant is about $9. And then you have to add on about 20% for the tip. So that comes out at about £9. A steak is between $50 and $57. And again, you have to add on about 20% for a tip. So you're talking about a steak being 50 quid, best part of. And multi-family starts in the US are rolling over. Now, we know that there's a whole lot of multi-family apartments under construction. And as those are completed, so higher interest rates are deterring new starts. But so far, we're not seeing any change in construction employment. Reminder, construction employment in March ticked up by 39,000. Small businesses in the US are not doing well, and actually they're increasingly concerned about poor sales. Although that is, in absolute terms, that is not a big number. Workers are increasingly concerned about losing a job, and that's quite a sharp rise over the last couple of months and reinforces the signs that the labour market is slowing. And concerns are particularly high for workers with an income above 50,000, which is everyone apart from the lowest paid workers, I think, in the US. When I was in the US, I was reading a Wall Street Journal article about a Walmart store manager, and Walmart store managers earn $250,000 with a maximum of $400,000, and that is higher than the UK Prime Minister. The Labour Market Conditions Index from the Kansas Fed ticked up in March, but that trend is falling, although the absolute number is still pretty good. Another thing that has supported the US economy is the fact that they own a lot of equities. So this chart shows that 30% of US households hold equities compared to just 9 or 10% in Europe. And rising stock market means they're wealthier. And so for every dollar that citizens' assets rise, they tend to spend between 2 and 3 cents. So rising assets prices lead to stronger demand supporting the economy. If the US equity market turns down, as it has in the last couple of weeks, then you may see that reverse. Okay, so in summary, despite the blowout non-farm payrolls for March, there are increasing signs of a slowdown in the US labour market. And also the US housing market, is it finally showing signs of slowing? We've said this many times. Let's wait and see until there's some effect on employment. And soft landing watch. Although the Indeed job postings index is ticking down, the active job listings on LinkUp have stopped falling and have picked up. So is that a sign that Labor market in the US is actually just fine. What we know is that the financial markets are very relaxed about the state of corporations, and bond spreads are pretty much at their lows. So market is not concerned about credit quality. Even CCC bond spreads have fallen in the past year. Market doesn't think there's going to be any defaults. Global shipping volumes are shooting up. So manufacturing activity, goods trade picking up. Business confidence is picking up. And the rise in the stock market means that household assets are growing much faster than liabilities. And according to the Manpower Survey, employers are still net planning to hire. The jobs market remains tight. Global manufacturing has bottomed and is strengthening. But how strong can it get when interest rates are this high? Lots of big durable goods might require financing, so buying a car, etc. Most people buy that on credit, and when interest rates are high, so that will affect demand. So it's questionable how strong the turn in the global manufacturing cycle will be. But if we take away one chart from the soft landing section, it should be this one. This is percentage of US consumers who are planning a foreign vacation, and it shows that it's at an all-time high, and there's a huge change post-pandemic. So post-pandemic, people want to live. They want to they realize life is potentially short, and they want to go out and spend. Now, the Brave Butler's Kelly indices, which aim to use real-time data in the US to give an idea of how the US economy is doing, shows that it's doing just fine. The leading index is doing very well. The coincident index doing just fine. Bottom line, there's absolutely no sign of a US recession on the horizon. On to good news. Okay, so here's a puzzle. Global sea levels have been rising. They have risen by about 7.5 centimeters over the past 20 years, which is actually quite a lot. And you'll all have heard about the dangers to low-lying Pacific islands and the Maldives. Well, why haven't we heard more about that? Why aren't they all slowly disappearing beneath the waves? Well, it turns out they're not slowly disappearing beneath the waves. In fact, their landmass is increasing. It appears that what's happening is when sea levels are higher, the waves are bigger, and most of these islands are created by waves breaking up the coral reefs and depositing the debris on the islands. So these islands are accumulations of broken up coral reefs. Higher seas equals higher waves equals more sedimentation. So actually, rising sea levels could perversely cause these islands to keep growing. And actually, the Maldives were created when sea levels were higher than they are now. And onto equities, and generally a poor couple of weeks. So this is the FTSE All World Index, down 3.1% over the last couple of weeks, down, but up 2.9% so far this year. The All Share down 1.7%, up only 1% year to date. Euro stocks down 2.7%, but up 3.8% year to date. Still mystifying given the high interest rates in the EU and the fact the EU economy is not doing very well, frankly. S&P 500 down 2.8% over the last couple of weeks, up 4.8% year to date. Huge rises since their lows in last October. NASDAQ down 2.8%, up 4% year to date. Russell 2000, though, has had a very poor couple of weeks, down 5.4%. It has once again failed to defend the 2000 level and is down 4.1%. Now, the Russell 2000, it consists of the broad mass of US companies, and it gives a better view of how the average company in the US is doing. Not great is the answer. Hang Seng down 3%, down 4.8% year to date. Topics down 2.8%, but still up 11% year to date. Bitcoin, even Bitcoin took a bit of a knock, down 4%, up only 50% year to date. Sterling down 1.5%, down 2.4% year to date. Let me tell you, the US is very expensive for Brits at the moment. The euro down 1.7%, down 3.7% year to date. Dollar index up 1.7%, as the markets expect US interest rates stay higher for longer, which supports the currency. It's up almost 5% year to date. VIX jumped sharply as equity markets corrected. Some charts relating to equity markets. So, question mark, is the S&P 500 forming a double top? It's stalling close to its previous highs. Now, my problem with equities is that interest rates have shot up, and that should be bad for equities. So higher bond yields should mean that investors demand higher earnings yield from equities. So the PE ratio should fall. And you can see here that in periods of high inflation, inflation is generally bad for equities. So when inflation is above 6% and rising, bonds actually tend to outperform equities. By bonds, we mean T-bills, so short-term bonds. And the same is true when inflation is above 4% and rising. When it's above 2% and rising, which is kind of where we are now over the last 3 months in the US, then it's much more balanced, but there's very little difference between the performance of short-term bonds and equities. So equities particularly do well when inflation is falling. So resurgence in inflation would be very bad for equities, he says. And Treasury bills now offer almost 4 times the yield than dividends on the S&P 500. And that is something that's occurred only once before during the dot-com boom, and is generally a very bad sign. Either the dividend yield needs to rise or the cash yield needs to fall. And this is a strongly mean reverting chart. The latest data on the S&P 500 is that it is just above 5,000. So that means it has broken decisively through its 50-day moving average. Is it going to test its 200-day moving average, which would be about 4,700? Now, I found this chart really interesting. So you will be aware that during a correction, all correlations tend towards 1. So everything drops. Well, it turns out the opposite is also true. When the stock market is doing really well, correlations trend towards 0. So everything just does its own. So each equity does its own thing. Each asset does its own thing. These are pairwise stock correlations, and they have been incredibly low. Another sign of market euphoria. Over the past 15 years, tech has massively outperformed energy. Is it time for the opposite to start occurring? Is it time to switch into energy? And at the same time, will real assets now start to outperform financial ones as interest rates stay high? And that should start to affect the prices of the financial assets. Hasn't done so far, but gold is now doing better than equities, as are industrial metals. US retail investors suffered a 35% drawdown between 2021 and 2023 because they were very long tech, but they stuck with it and have now got back to their previous highs. And this is corporate insiders. Not many of them are buying. That is a low. They are not buying into the equity rally. Worrying for bulls. But one thing that I totally got wrong is failing to see the strong cyclical upturn in corporate earnings in the US over the past year. It's actually had a very strong rise, the strongest in history. Onto commodities, quick summary. And energy, despite the conflict in the Middle East between Israel and Iran over the last couple of weeks, they're net down. So the markets have discounted that conflict widening into a wider and deeper regional conflict. Industrial metals, however, have had a really good couple of weeks. I'll show you the charts in a second, but general strength, market anticipating an upturn in the manufacturing cycle leading to stronger commodity demand. Precious metals also up strongly on fears of conflict in the Middle East, but also monetary debasement and resurgent inflation. So energy, so Brent down 3.5% over the last couple of weeks, still up 14% year to date and ticking up this morning as Israel has apparently bombarded Iran. Let's see if the tit for tat continues. WTI also down 3.8% over the last couple of weeks, up 17% year to date. Numbers specific to the oil market, well, this is a surprise. Over the last couple of weeks, we've seen strong rise in inventory levels in the US, up 22 million barrels. So the US oil market has been well supplied, which would be bearish for oil prices. US crude production stable at 13.1 million barrels a day, which is below where they started the year. Baker Hughes rig count unchanged. Now, Chinese oil demand is expected to continue rising in the current years, and rising EV penetration in China has not yet affected demand in any way. So far this year, US oil production has fallen. Now, the EIA are forecasting it will fully recover by Q4 and will rise by around 200,000 barrels a day to hit a new high of 13.47 million. But Standard Chartered are skeptical. They're saying there'll be no growth from US shale. The US shale is actually now struggling to grow given the high decline rates. If that's true, very bullish oil prices long term. Turning to natural gas, tensions in the Middle East with the potential of gas supply disruptions from Qatar have led to a rise in European gas futures. They're up 22% over the last couple of weeks, and they are now pretty much flat on the year. That's very bad for UK consumers, European consumers, and inflation. UK shows a very similar chart, up 25% over the last couple of weeks, up on the year now. Not good. US natural gas not joining in. So the rise in European gas futures is all about supply disruption fears. Coal up 10%. So joining in with natural gas, still down on the year. Uranium has leveled off a bit, so up 2.6% over the last couple of weeks, down 1.9% on the year. And onto industrial metals. Well, really strong rises in industrial metals. So this is aluminium up 8.3% over the last 2 weeks, up 10% year to date. So I'm going to read this out. Aluminium futures traded above the 2,600 per ton level, holding its recent surge the highest since early 2023, as Western sanctions on Russian metals threatened the availability of the metal. The US and UK jointly banned new deliveries of Russian aluminium to the LME, limiting the metal's availability at one of the world's benchmark exchanges. Additionally, supply prospects were hurt by fears that Western consumers would be hesitant to engage in Russian metal buying outside the LME. And elsewhere, supplies from Guinea were disrupted following an explosion at a key fuel depot. Supplies from Yunnan, China's fourth largest aluminium producing region, remained low due to the dry season, reducing hydroelectricity, I presume. So we're seeing reduced supply from Russia and China and Guinea. Cobalt not joining in, continues to drift off, down 2.5% in the last couple of weeks, down 5% year to date. Copper, though, Dr. Copper is diagnosing a resurgent global economy. I'm going to read this out as well. Copper futures surged to above $4.4 a pound in April, the highest in 2 years, as concerns of low supply were met with signs of traction in demand. Satellite data show that copper smelters in China, the world's largest producer of refined copper, decreased activity levels in line with pledges to reduce their output by up to 10% this year. This move marks a response to the low supply of copper ore for Chinese smelters, magnifying the sector's overcapacity and driving down their fees. Supply has suffered a wave of disruption. Zambia has suspended activity in key mines due to power shortages. Panama's Cobra mine has shut down, and many South American mines have failed to meet their production guidance in last year. Meanwhile, China has been importing a lot, helped by surging manufacturing PMIs. But what's China up to? It's stockpiling copper. There is a seasonal effect here, but we're way above seasonality. Concerning. If that gets released onto the market, the copper price collapses again. Chromium going nowhere. Iron ore bouncing back, still down 25% on the year, but, has it bottomed? Lithium going nowhere, but has bottomed. Neodymium, good bounce, actually, but they're still down 12.5% on the year. Nickel rising, despite all those fears about huge Indonesian production over the next few years. Tin, kaboom, up 15% in the last couple of weeks, up 30% year to date. Big numbers. Semiconductor demand resurgent. Ferrovanadium going nowhere. Zinc joining in, up 8%, now up 6.8% on the year. On to precious metals. Precious metals, great couple of weeks. War in the Middle East, resurgent inflation have led to flight to safety. So that is up 16% year to date. Congratulations to all the holders. And it's close to a technical breakout. Let's see it heading towards 3,000 and then maybe 4,000, he says. Although the trouble with gold is it has lots of these surges and then falls back. Long term, gold, which you would expect to perform in line with inflation, has a very similar return to bonds. So question of which is the safer asset. Actually, their returns are very similar. It's not a question of holding either gold or bonds. It's probably holding a bit of both in your portfolio. The recent rally on the gold price has not been led by retail. They've not joined in yet. If they do, gold price could go stratospheric, he says. Silver joined in, up 6.2%, up 17% year to date. Platinum ticked up 2%. Rhodium no longer falling, is actually up on the year. Palladium up 1.3%, still down 14% on the year. Now, in previous weeks, we've covered how the EV market is struggling and how electric vehicle sales growth is actually going to be lower in 2024 than in 2023. So the energy transition is stalling, and that actually should mean prolonged demand for PGM metals in our catalytic converters, and that should support PGM prices. Haven't seen it yet, but potentially bullish long term. And on to interest rates. Well, this sadly is the UK yield curve. It has shifted decisively higher over the last month as inflation in the US in particular has been stronger than anticipated. But latest UK inflation numbers also not terribly reassuring. The Bank of England is now expected to cut rates later than previously. US really bad. So big rises in the yield curve across the curve as US inflation has stayed high. Now, if you look at a decomposition of what's behind the rise in US 10-year yields, it's all due to growth expectations. There's no evidence thus far that the huge US deficit is causing indigestion in the US. So investors are balking at having to buy so many bonds. There's no rise in demanded real yields. And to add to the potential problems of funding the US deficit, China has stepped back from buying treasuries. It's buying gold. So who's going to fund the US deficit in the coming years? Turning to the charts, this is the UK 2-year, risen sharply over the past couple of weeks. Bad for me. 10-year, the same. New highs for the year. 30-year, new highs for the year. All not good, all causing me problems. US 10-year, that's an ugly looking chart. Yields rising steadily. German 10-year, actually not really rising. Same with Italian, ticked up a bit, but the ECB is expected to start cutting rates in a couple of months now. Greek, the same. Concluding comments. Well, equities and bonds have sold off in the last couple of weeks on fears that US inflation is resurgent, meaning US interest rates will remain higher for longer. The fiscal deficit of 5.6% in the US. Reminder, the US economy is growing at, we estimate, the Atlanta Fed estimates a 2.9% annualized rate in Q1, which is a decent number, higher than its long-term estimated capacity. But the US is running a pro-cyclical fiscal policy. The fiscal deficit should be much lower than this when the economy is doing well, expecting that the fiscal deficit will then rise sharply when there's a recession. If the US were now to go into recession, what would the deficit be? 8%, 10%? Absolutely enormous numbers. The flip side of the US running such an enormous deficit is that interest rates will have to stay higher for much longer. Industrial commodities are surging, suggesting that markets are confident that the global manufacturing cycle has bottomed, and precious metals have surged on fears of monetary debasement and tensions in the Middle East. Now, how have I done? Well, it's been shit, frankly. I've got this totally wrong, as I have been, telling you all year. Sadly, all the intellectual effort I put into putting this weekly together has resulted in me making entirely the wrong decisions over the last year, and I'm now down 10% on the year and massively underperforming just about everyone. But before I went to Boston, I made some hard decisions. So I decided that my strategy was not working, that my analysis was wrong, and it was time to cut risks. I was very massively long duration, and I decided to get out of all my US long bonds. Now, my US long bonds are in my main portfolio and not in the figures I report every week, which is my SIP. So I closed those at a loss of 14%, not much fun. I also closed out all of my winning gilts positions. And yes, there were a few, although the gilts prices I report here, these are not big numbers for decent returns, and those include inflation. So in real terms, really made nothing at all. So what have I bought? Well, I bought short term. In essence, I have de-risked the portfolio. So I have kept my big losing positions in long-dated UK gilts, and I still expect those bets to come good eventually. But by cutting the risk, that means that I don't frankly obsess about the P&L every day. And also gives me a chance to reappraise where we are and to react should there be any opportunities. And I think there's lots going on in the world, and the chance of an accident is quite high, which means I now have cash to react if there is an accident. In particular, I'm concerned about the US, where massive fiscal deficits mean that the US Treasury has to sell literally trillions of dollars of new treasuries every year. And will there be a buyer's strike? Will there be a spike in US Treasuries? If there is, they'll have enormous knock-on effects in the world. And I now have cash short-term bonds which I can sell to buy if there is some sort of a sell-off in anything. People always underestimate the optionality of cash. Historically, I have made my money by being in cash for long periods of times and then reacting when there is a big sell-off. And we've had a small sell-off in equities. Will it get worse? I'll just be discussing the outlook for everything in depth next week when Richard returns. In the meantime, thank you very much for watching. Normal service resumes next week with Richard. Please can you press like and subscribe to the channel. And in the meantime, it's goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.